Every bad real estate investment I've ever seen had one thing in common. Someone fell in love with the deal before they actually asked the right questions. That's how investors end up buying properties with negative cash flow, unrealistic projections, hidden risk, and returns that look incredible on a spreadsheet but disappoint for years. So before I invest a single dollar, I force myself to answer 5 questions. If I can't confidently answer all 5, then I just walk away. It doesn't matter how beautiful the property is, it doesn't matter how good the sales pitch sounds, and it doesn't matter if everyone else is buying. And today I'm going to share that exact framework. These are the same questions I use to evaluate apartment syndications, private real estate funds, and passive investments. And they've saved me from deals that looked amazing on the surface, but actually were fundamentally flawed. Stay until the end because the 5th question is the one that almost every new investor ignores. And in my opinion, it's the difference between building long-term wealth and becoming someone else's exit strategy. And make sure to like this video, share with a friend, and subscribe to our channel so you don't miss our weekly videos. Here's the thing. We're operating in a very specific market right now. According to CBRE's 2026 U.S. real estate market outlook, commercial real estate investment activity is expected to grow 16% this year, reaching over $562 billion. That's a lot of capital chasing deals, which means one thing, not every deal deserves your money. So let's break down exactly how to filter the good from the bad, starting with question number 1. Question 1, does this deal actually cash flow? Or am I just hoping it will? This is the most fundamental question in real estate investing, and you'd be shocked how many people actually skip it. Cash flow is what's left in your pocket after every single expense is paid, and every expense: mortgage, taxes, insurance, property management, vacancy, maintenance, capital expenditures, all of it. Here's a simple example. Say you're looking at a property that rents for $2,500 a month. That sounds great, but once you subtract a 5% vacancy rate, a 10% property management fee, taxes, insurance, and a maintenance reserve, you might be left with like $300 a month in actual cash flow, maybe less. Now, $300 a month, is that worth your capital? That kind of depends, but at least you know the real number. The metric you want to focus on here is cash on cash. That's your annual cash flow divided by the total cash you invested. According to Bigger Pockets, most experienced investors target a minimum of 8% cash on cash. Anything below that, you need a very compelling reason to move forward. If the numbers don't work at today's interest rates, and rates are still elevated in 2026, with CBRE projecting that the Fed funds holding in a range of like 3 to 3.25, then the deal doesn't work, period. Don't fall in love with a property, fall in love with the numbers. Question 2, what does this market actually look like and where is it headed? Location is not just about a good neighborhood versus a bad neighborhood. It's about economic fundamentals. I want to know, what are the job growth trends? Is the population growing or shrinking? What's the vacancy rate for rentals in this submarket? JLL's Global Real Estate Perspective from May 2026 reported that global direct transaction volumes actually rose 18% year over year in the quarter that just ended. But here's the data what the data also shows us. Not all markets are rising equally. Some submarkets are thriving, others not so much. And before I invest, I want to know, what are the employers, the median household income, what's the new supply coming to market? Because if 500 new apartment units are being built 2 miles away, that affects your vacancy rate and your ability to raise rents. A strong market can forgive a mediocre deal. A weak market will punish even a great one. Question 3, how can this deal lose money? I know most people don't want to think about this one, but this is actually the question that separates disciplined investors from straight up gamblers. Every deal has a downside scenario, period. I want to know what it is before I invest a single dollar, not after. The white coat investor puts it simply. Ask yourself what the stress test looks like. What happens if vacancy rose from 5% to 15%? What if rents drop 10%? What if you need a major capital repair like a HVAC system, a roof, etc., etc.? Run the numbers on the worst case. If the deal still survives the stress test, that's pretty worth considering. If it falls apart the moment anything goes wrong, you might want to pass on that one. Smart investing isn't about being pessimistic, it's about being prepared. Question 4, Who is operating this deal and do I trust them? This question matters enormously if you're investing passively, meaning you're putting money into a syndication or a real estate fund rather than buying and managing a property yourself. The operator, which is the person or team running the deal, can make or break your investment. A great property in the wrong hands will underperform. A mediocre property in the right hands can exceed projections. And here's what I look for personally. I want to know what their track record is, not just their wins, but I want to know their losses. I want to know how they handled a deal that went sideways, because every experienced operator has had one. The question is, what did they do about it? The White Coat Investor recommends a specific question that most investors never ask. How much of your own money is in the deal? If the operator has real skin in the game, their own capital at risk, their incentives are aligned with yours. Also ask, how are investors kept informed? How often do you receive distributions? What are all the fees? Acquisition fees, asset management fees, disposition fees. Transparency here is non-negotiable. If an operator gets defensive or vague when you ask these questions, that's your answer. And question 5, does this investment fit with your personal goals right now? This is the question most people forget entirely. Real estate is not a liquid asset. When you invest, your capital is tied up, sometimes for 5, 7, even 10 years. So before you write a single check, you need to ask, can I afford to have this money locked up? Does this investment match my timeline, my situation, my risk tolerance? According to Bigger Pockets, one of the most common mistakes new investors make is buying a deal that's right for someone else's goal, but not their own. And here's the reframe. A high cash flow deal in a secondary market might be perfect for someone who needs income today, but a value add deal in a growing metro might be better for someone building long-term equity. Neither is wrong, but they serve very different investors. Know what a win looks like for you this year and 5 years from now. And here's a quick objection I hear all the time. But what if I wait too long and miss the market? Here's the truth. CBRE's 2026 outlook confirms that returns this cycle will be primarily income driven, not appreciation driven. That means the fundamentals of a deal matter more than ever. Buying a bad deal quickly is far more expensive than taking 60 extra days to find a good one. Patience is a competitive advantage right now, which is quite unfortunate. Imagine this. 2 years from now, you've invested in 2 or 3 deals that you thoroughly vetted using these 5 questions. Your cash-on-cash return is averaging about 9%. You're receiving quarterly distributions. Your capital is working while you sleep. That's not a fantasy. That's what disciplined, conservative real estate investing looks like when you do the work up front. And the compounding effect is real. If you deploy capital into one solid deal this year, and then you reinvest those returns into another one in year 3, the trajectory changes dramatically. Not because you got lucky, because you actually asked the right questions before you ever signed anything. And now here's your challenge. Take the next deal that lands in your inbox or the next property you're considering and run it through all of these 5 questions we just covered. Write your answers down. See how the deal holds up. If it passes all 5, listen, you might have something worth pursuing. And if it doesn't, you just saved yourself from a very expensive, painful lesson. Now, if you're serious about building long-term passive income through real estate and you want to go deeper into what we covered today, then I want you to visit my website, cardiarei.com. When you go there, you'll find 2 free ebooks you can download right now that I wrote. And more importantly, you'll get access to a completely free 9-part masterclass in passive investing that I created for you. Inside that training, I walk you through the exact framework that many investors use to build long-term passive income through real estate, step by step. It's designed specifically for busy professionals, doctors, engineers, lawyers, executives, small business owners, whoever. People who want conservative, long-term returns without becoming full-time landlords or property managers themselves. It's completely free. It's the things that I wish I would have had on day one. And it's a natural next step from everything that we covered in this video. If the 5 questions resonated with you today, the training will take you from framework to action. It's a difference between knowing what to ask and actually knowing what to do next. So if you're serious about building real lasting passive income, go ahead and go to, again, cardiarei.com. And if you found this video valuable, hit that like button and subscribe and watch the next video. We're going to go deeper in how to analyze that first passive real estate deal from start to finish. And I'll see you there.